Are we on the brink of unprecedented market shifts? Discover the latest from market experts on political impacts, technical indicators, and global economic trends. Joseph Wang unveils the influence of U.S. elections on bond markets, while Matt from Trade Brigade highlights a pivotal market level to watch. Brian from EPB Research warns of China's real estate crisis, and Michael Kramer discusses the impacts of upcoming economic data releases. Don't miss these critical insights that could redefine your investment strategy. Like and subscribe for more financial wisdom. Today, on Financial Analysis in Review, we will summarize the following videos. From Joseph Wang, we have Markets Weekly, June 29th, 2024. From Trade Brigade, we have The Market Must Hold This Level Daily Reversal. From EPB Research, we have Can China Handle a Real Estate Meltdown? From Mott Capital's Market Chronicles, we have Massive Data Dump Could Strengthen First Half Market Trends. From Eurodollar University, we have The Japanese Yen is Crashing, What This Means for the World. Welcome to another incisive edition of Markets Weekly, where the complexities of the financial world are unraveled by our astute host, Joseph Wang. Today, Wang embarks on a significant exploration of pivotal global political events, their impact on markets, and the broader economic implications. Joseph Wang is an experienced market analyst with an extensive background in finance and central banking, making him well-equipped to tackle these profound topics. The core thesis of this episode delves into the interplay between political developments and market reactions. Wang adeptly argues that recent and upcoming political events, ranging from the U.S. presidential debate to whispers about the demise of the petrodollar and crucial French elections, are creating a landscape of uncertainty, turbulence, and potential market instabilities. Here are the key points discussed by Joseph Wang. U.S. presidential debate impact. President Trump and President Biden faced off in a debate, revealing significant public concerns about Biden's capability, which could reshape the Democratic nomination. Betting markets now rate Trump's victory chances at 60%, while Biden's chances have dropped to 30%. Trump's stance on inflation and protectionist policies is influencing bond and prison stocks, foreshadowing dramatic fiscal policy shifts. Petrodollar demise speculation. Wang explains the origins of the petrodollar system, which emerged during the Cold War to stabilize the U.S. Treasury market through Middle Eastern oil revenues. Concerns that oil-producing countries might move away from the dollar are prevalent but overstated. The ultimate investment of acquired currencies, not the currency itself, is what matters. Despite fiscal deficits and potential sanctions, U.S. markets remain the most liquid and attractive for surplus investments, maintaining the petrodollar system's stability. French elections and market influence. The French legislative elections feature two leading forces from opposite political spectrums, the far-right Rassemblement National and the far-left Front Populaire. A victory for either party is expected to bring significant policy changes, potentially increasing social benefits and taxes, negatively impacting economic growth and market stability. French market uncertainties due to fiscal spending and high yield spreads are causing significant financial stress, which could resonate across European and global markets. Joseph Wang made the following predictions. Increased market volatility. Joseph Wang predicts heightened market turbulence given the political uncertainties, particularly concerning the U.S. elections and French legislative outcomes. Markets could experience further destabilization depending on the final Democratic nominee and results from the French elections. Sustained petrodollar influence. Despite ongoing discussions, Wang asserts that the petrodollar system will maintain its influence due to the intrinsic liquidity and stability of U.S. financial markets. Joseph Wang concludes by emphasizing the critical role of political dynamics in shaping market trajectories. He advises caution, noting the potential for substantial shifts in market behavior in response to political developments. Wang underscores the importance of staying informed and diversified in these volatile times, and invites listeners to explore his blog and courses for deeper insights. In this engaging episode of Trade Brigade, host Matt dives into the latest market dynamics, pinpointing a critical technical level that held strong despite recent sell-offs. The episode is packed with detailed analyses of market trends, technical indicators, and future predictions. Matt is a seasoned trader with extensive knowledge of market behaviors, but note that his views might be influenced by his trading strategies and market perspective. The core thesis revolves around a key technical level on the charts that managed to hold up despite significant selling pressure. Matt emphasizes that this level will be crucial for the upcoming week as the market reacts to economic data and potentially quiet trading days due to the Independence Day holiday. The episode aims to analyze why this level is pivotal, supported by discussing a bullish divergence that aligns with this critical point. Here are the key points discussed by Matt: market conditions and key level. Despite sell-offs, a crucial technical level on the charts held up, indicating potential buyer support. Matt transitions from monthly to weekly and then to daily charts, dissecting structural patterns and suggesting the market's overall uptrend remains intact. Key levels discussed include the 54 through 320 mark on the S&P 500, which if broken, could signal a deeper pullback. Structural analysis. On monthly charts, recent candles show buyers stepping up near low ranges, indicating support and maintaining the trend's upward trajectory. Weekly charts reveal potential inverted hammers, which hint at probable pullbacks, yet overall uptrend maintains integrity. Upper and lower targets. For potential upper targets, Matt discusses reaching levels around 565 and 610 on the S&P 500 if the uptrend continues. For lower targets in case of pullbacks, levels around 500, 475, and 473 were highlighted as significant support areas. Market internals and participation. Market internals like cumulative tick and advanced decline lines suggested neutral to mildly bearish sentiment, but not outright panic. Matt identifies certain days as potential game changers, particularly around anticipated low activity due to the holiday. Matt made the following predictions: potential retracement. If the key level of 54 through 20 is broken, Matt predicts a pullback towards levels like 54,032 and 537 on the S&P 500. He also mentions the importance of areas like 53140 and 530, indicating higher lows would mark bullish reversals. Continued uptrend. On a bullish note, Matt predicts that sustained price action above noted levels could push the S&P towards 565 and 610. This would require consistent buyer support and possibly the influence of positive economic data. Matt concludes by reinforcing the importance of the critical technical level and advises viewers to carefully watch market behavior around this point. He encourages traders to stay tuned for market updates, particularly through expected economic data releases and potential trading impacts from the holiday-shortened week. With an emphasis on both caution and opportunity, he hints at bullish trade ideas in the latter part of the episode. Welcome back to EPB Research. Today's video is an in-depth analysis of China's complex real estate crisis and its larger economic implications. Our guest today is Brian, a distinguished China expert from a renowned research firm. With years of experience focusing on China's economy and an unbiased perspective, Brian dives deep into this pressing issue. The core thesis of this video centers around China's mounting problems stemming from its real estate sector, heavily influenced by demographic shifts and a series of economic missteps. Brian posits that China's current economic trajectory could lead to a severe devaluation of its currency and even geopolitical maneuvers if not handled effectively. Here are the key points discussed by Brian: demographic challenges. China's working-age population peaked a few years ago due to the long-term effects of the one-child policy, and this demographic decline poses significant challenges to the housing market. Brian explains that efforts to reverse this demographic trend have largely been ineffective, contributing to a systemic doom loop in the real estate sector. Real estate crisis. China faces a colossal capital misallocation blunder, estimated in the tens of trillions of dollars, making this far worse than Japan's 1990s housing bubble. Housing valuations have effectively halved from their peak of around $75 trillion, leading to massive wealth destruction. Economic indicators. The Producer Price Index, PPI, in China has been deeply negative, reflecting declining industrial profits and indicating deflationary pressures in the economy. Despite low growth rates in credit, China continues to grow its credit at an annual rate of 8.6%, contributing to the world's largest malinvestment program. Brian made the following predictions. Currency devaluation. Brian predicts that China will inevitably have to conduct a large-scale devaluation of its currency, a move that will not be controlled or gradual. Such a drastic step may lead to severe inflationary pressures, which could destabilize the country's social fabric. Geopolitical maneuvers. Brian warns about the potential for China to make aggressive geopolitical moves, such as acquiring territories like Taiwan, to offset economic shortcomings. This Taiwan scenario suggests that China might leverage territorial acquisitions to integrate young, dynamic populations into its economic system. In summarizing, Brian strongly suggests that China's current economic policies are not tenable in the long run. The nation must acknowledge and address its economic misallocations and demographic issues. The looming possibility of currency devaluation and potential geopolitical aggression only underscore the urgency of these issues. As a call to action, viewers should keep an eye on China's economic indicators and possible geopolitical movements, given their far-reaching implications. Welcome back to Mott Capital's Market Chronicles, where today's discussion focuses on the near-term market outlook amid an action-packed week of economic data releases and key global events. Our guest is the channel's very own Michael Kramer, a seasoned market strategist known for his insightful and data-driven analyses in the investment community. The upcoming week will be crucial for market trends, driven by a slew of economic data releases, major elections in Europe, and the Federal Reserve's minutes. Kramer emphasizes the potential impacts these events could have on market volatility, risk assets, and interest rates, creating an interplay that may shift typical seasonal market behaviors. Here are the key points discussed by Michael Kramer, Global Events and Economic Data. French parliamentary elections on Sunday and UK general elections on July 4th could significantly impact risk assets and currencies. The release of Fed minutes on Wednesday at 2 p.m., followed by the U.S. job report on Friday, adds to the week's compressed schedule of crucial events. Kramer notes the potential volatility leading up to the job report, diverging from the usual pattern of declining volatility during shorter trading weeks. PCE and durable goods data. The PCE report showed minor deviations with personal spending missing expectations. Durable goods data has shown a deflationary impact recently, particularly in categories like furnishings and recreational goods. Shipping costs and housing data suggest inflation pressures might be revisited between July and September. Interest rates and global markets. 10-year rates and other long-term rates have been on an upward trend since the start of the year. Global bond markets saw rising rates, partly influenced by the European bond markets and Japan's new finance minister. Market indicators and elections. A weakening British pound and euro amid political uncertainties could strengthen the US dollar. Stronger than expected PMI data from Chicago and optimistic job and wage growth predictions support rising interest rate trends. Tensions in Europe could impact the spread between French and German bonds, indicating market reactions to election outcomes. Michael Kramer made the following predictions: interest rate trends. Kramer anticipates that U.S. 10-year rates will continue their upward momentum, breaching key resistance levels. He predicts that sustained strong economic data from the U.S. will further support the rise in interest rates. Market volatility. Kramer foresees increased market volatility due to the converging timings of significant data releases and global elections. He suggests that traditional seasonal market effects might be distorted due to the current landscape, particularly noting potential heightened volatility in early July. Dollar and risk assets. Kramer predicts the U.S. dollar could gain further strength against weakening European currencies. He also highlights potential short-term market tops in indices such as the S&P 500 and NASDAQ, subject to key support levels being tested. Michael Kramer concludes by urging caution, noting the unprecedented convergence of impactful events in a short period. He underscores the importance of monitoring economic indicators, particularly in light of potential rising interest rates, global market reactions to elections, and unusual volatility patterns. For those interested in deeper analysis, he invites viewers to check out his Substack and Seeking Alpha content for more detailed insights. Welcome to Eurodollar University. In today's video, we dive into a significant global economic concern, the crashing Japanese yen. Our guest today unravels the complexity behind this, exploring what it means for the world at large. The core thesis of this episode delves into the deteriorating value of the Japanese yen, debunking the popular narrative that it is solely influenced by the Federal Reserve policies and interest rate differentials. Instead, it's revealed that the yen's downfall is a signal of broader, more ominous global economic instability centered in Asia. Here are the key points discussed by host from Eurodollar University Government Intervention Ineffectiveness. Japan's recent $60 billion intervention in the currency market has largely failed to strengthen the yen, barely making a difference in long-term trends. The yen continues to hit its weakest levels since 1986, despite numerous interventions, highlighting government impotence in reversing the currency's decline. Flawed mainstream explanations. Contrary to popular belief, the yen's weakness isn't predominantly caused by U.S. Federal Reserve rate policies or interest rate differentials. Evidence shows that while interest rate differentials affected the yen in the short term, recent data suggests this is no longer a significant factor. Global economic warnings. The persistent weakening of the yen, irrespective of Japan's economic fundamentals, indicates brewing global economic trouble, particularly in Asia. Historical parallels are drawn with previous periods of global crises, such as the Asian financial crisis of 1997-98 and the economic downturn in 2014-2015. Host from Eurodollar University made the following predictions. Continued yen weakness. Expect continued depreciation of the yen despite any short-term interventions or policy changes by the Japanese government. Such interventions will likely expose the limits of government power and have minimal long-term impact. Global economic unrest. The yen's behavior signals potential global economic disruptions, with a primary focus on Asia. This economic volatility could mirror past crises, impacting global markets and economies substantially. The key takeaway from this episode is the futility of relying on government interventions to stabilize the yen amidst deeper, unresolved global economic issues. As the yen continues to crumble, it's a red flag indicating broader instability, urging policymakers and investors alike to brace for potential significant global economic disruptions. In this set of videos, experts provided a deep dive into various market dynamics. Joseph Wang forecasted increased market volatility driven by political events in the U.S. and French elections, while affirming the sustained influence of the petrodollar system. Mott from Trade Brigade emphasized the importance of a key technical level on the S&P 500, suggesting significant implications for market direction. Brian from EPB Research highlighted China's looming real estate crisis and its economic ripple effects, including a potential drastic currency devaluation. Michael Kramer predicted ongoing interest rate hikes and heightened market volatility due to the convergence of global events and economic data releases. While all guests underscored the importance of staying informed, they showed varying levels of optimism concerning market resilience. Dive deeper for strategic investment insights and keep an eye on these evolving trends. Thanks for watching Financial Analysis in Review for June 30th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.